In this part of the briefing, my colleague Jason Bram and I will review current trends in employment in the region. Now, we'll begin with a brief review of general economic trends in the region. We'll first review, and then we'll turn specifically to employment. We'll first review the downturn in employment in the region and highlight New York job losses were less severe than in the nation. New Jersey's losses were on a par with the nation, and Puerto Rico was particularly hard hit. We'll then focus on the upturn, or the recovery of employment to date, and we'll show that most of the region has begun to rebound to varying degrees, despite substantial losses in state and local government. We'll close with our outlook, and here we'll emphasize that employment growth in the region will hinge on the continued expansion of private service sector jobs. Okay, so I want to set the stage for the review by presenting our indexes of coincident economic indicators. As we've described in earlier briefings, these indexes are single composite measures that we construct here at the bank and we use to track conditions in New York State, New York City, and New Jersey. And this is our index for New York City. And just a word about the chart. The shaded portion represents the period of the national downturn. Activity peaked in December of 2007, and the recession ended in June of 2009. Now, we index each of our local CEIs to the peak, December of 2007, start the index a year before the peak, and trace out its movements in recession and recovery. Now, the chart shows that in New York City, activity peaked after the peak in the nation about 4 months later in April of 2008. It declined during the downturn and bottomed out in November of 2009, but since that date has been on a steady and sustained increase. Now, a similar index constructed, New York State, shows a similar pattern, a somewhat deeper decline during the downturn, but again, since November of 2009, a steady and sustained recovery. Now, these indexes make use of the annual benchmark revised data that came out a few months ago, and again, no longer show the pause in activity in New York State and New York City at the end of last year that we had noted in our previous briefing. Now, in New Jersey, activity declined and has basically remained essentially flat for over a year. The last 2 months the index has picked up, and it's suggestive that a recovery may be underway in the state. Now, we also report the index for Puerto Rico. This is the index developed by the Government Development Bank of Puerto Rico, and it shows that the decline, which really began in November of 2005 on the island, continued during the downturn, although there are some signs recently that the pace of that decline has slowed. Okay, now I want to turn to the unemployment rate. This is a chart of the unemployment rate nationally, beginning with the downturn in the early 1990s through the 2001 recession and into the current recession. And the rise in the unemployment rate is stark, about 5.5% increase in the downturn to over 10% at its maximum. Over the past year, it has come down. Today's rate of 9% reflects that downward trend from the peak. Now, here's the also plotting the unemployment rate for New York City. We can see that in this downturn, the unemployment rate rose also sharply in the city and has come down with the nation. However, to note that over the period, New York City's unemployment rate is typically above that of the U.S. And so the fact that it's matching the rate in this cycle is at least suggestive that conditions here are probably a little better than they are nationwide. Similarly, with New York State, typically the rate is a little bit above the nation. It rose sharply again in this downturn, peaked, however, at 9% and has fallen since then to about 8%. And in New Jersey, the rate over this entire period has pretty closely tracked the nation, again showing the sharp rise in this downturn and subsequent moderate recovery. Now, we also show the unemployment rate for Puerto Rico. We plot that together with the U.S. rate. The unemployment rate in Puerto Rico is typically about twice as high as the U.S. rate. It also rose sharply during this downturn and has leveled off, but it remains stubbornly high at about 16.9%. Okay, now let's turn to employment. I want to frame our discussion by looking at an index of total employment at the national level. So this line represents total employment index to the peak of the cycle in December 2007. Despite the fact that the recession ended in June of 2009, employment nationally continued to fall through February of 2010. So we put the vertical line on the chart, and we're going to call this the period of employment downturn. And at that point, unemployment nationally had fallen by about 6.3% or over 8 million jobs. A subsequent recovery through March has continued, and it's increased by about 1% over that period. The blip in the chart represents the hiring and subsequent layoff of census workers that occurred in the spring of 2010, and that's going to show up in a number of our employment charts. Now, a similar measure for New York City shows that the decline in employment was shorter and less steep. Employment continued to grow after the national employment had peaked and picked up growth before the nation. In New York State, we have a similar pattern, and in upstate New York also. The decline was somewhat shorter and less steep, although the recovery of upstate New York has been less than New York City. In New Jersey, employment trends there closely track the nation in the downturn and into the recovery. Now, in Puerto Rico, the decline in employment that occurred continued the declines that had started before the declines on the mainland, continued into the recession, and were sharper than the nation, although recently there are some signs that the island may be turning the corner. Okay, now I want to put the declines in employment in this cycle in context. So I took the line that represents an index of employment for New York City in the current cycle, and I've constructed a similar index for the previous two cycles, the early 2000s downturn and the early 1990s downturn. And you can see that, again, in this cycle, the decline in employment was shorter and less steep than in either of those earlier downturns, particularly in the downturn that we saw here in the city in the early 1990s. Similar measure for New York State shows that the current downturn in terms of the steepness and the duration matches what we saw here in the early 2000s, but was actually, again, not as steep or as long as what we saw in the early 1990s. New Jersey's picture is a little different. Here, the decline was fairly strong in this downturn and was really much steeper and longer than what we saw in the early 2000s downturn in the state, and really more along the lines of the fairly severe downturn in the state in the early 1990s. Now, I want to put this in our region in a national context briefly. So I've got those same employment indexes for New York State and New York City and the U.S., and I want to add to that the index for Nevada. Now, based on this metric, Nevada's economy was the most seriously impacted in this downturn. Employment is down by about 14%. Another state that was fairly severely impacted is Florida, where employment is down about 10%. These are fairly steep and prolonged declines, although recently it looks like both states have turned the corner. Both states, of course, were affected by the boom-bust housing cycle, which adversely affected a number of areas of their economy. At the other extreme, we have North Dakota, where jobs continued to grow through the recession, and the state is up now about 5% from where it was at the peak of the prior downturn. Another area that has been growing, another state that's been growing is Texas. Both of these states had less of a boom-bust cycle in their housing markets, and are now recovery there is really being led by natural resources and construction. So now let's look at the industries that that were important in terms of the downturn. So the dark bars here represent the change in employment at the national level in major industries from the peak of activity in December of 2007 to the end of the employment downturn in February 2010. And here you can see that the education and health services sector continued to expand jobs in this downturn as it has in previous downturns. The government sector added modestly to jobs, but for the most part, across the whole spectrum of industries, there were fairly significant job losses. Leisure and hospitality, finance, certainly manufacturing and construction. Now, to look at our region, we put these These bars represent similar measures of employment change for New York State. And we can see, like the nation, the state continued to expand education and health services and government. Unlike the nation, leisure and hospitality jobs continued to grow during the downturn in New York State. And for the most part, with the exception of finance, where declines were fairly large, there were declines across the other industries, but those declines tended to be less than the nation. Now, in New Jersey, it's a slightly different picture. Education and health jobs continued to expand, but at a pace about half of the nation's. Government jobs had begun to decline. Leisure and hospitality employment also declined. And across the spectrum, finance, retail trade, professional and business services, manufacturing, and construction tended to have declines that roughly matched the nation. Now, I want to turn to New York State and separate out New York City from the upstate region. So this chart shows employment change in the downturn. Again, the bars representing the nation are the darker bars, and the bars showing employment change in New York City tend to match the state. Education and health services strong. Leisure and hospitality jobs expanded at a rapid pace here in New York City. Retail trade employment was also fairly stable. So the combination of that leisure and hospitality growth and fairly stable retail employment suggests that tourism at least helped to support job growth in the city during the downturn. Declines in other areas, professional and business services, and manufacturing and construction. Of course, there were job declines in those areas, but in professional business services and construction, they were less than what we saw nationally. Upstate, a kind of similar picture. Education and health service jobs growing. Government jobs and leisure and hospitality jobs expanding. Important for upstate, of course, is the manufacturing sector, and there they did see fairly substantial declines, roughly on par with the nation. But construction employment did not fall nearly as much as the nation, only about a third of the rate. And again, this reflects in part the lack of that boom-bust housing cycle in upstate New York, and so you didn't have the big swings in construction employment that you had in some other parts of the nation. Now, how did the downturn play out across the region? Well, this is the map, the New York-New Jersey region. The U.S. Decline in employment was 6.3%. Regionally, the decline was about 4%. We've got three areas here that declined more or less at the same pace as the nation. The Newark metropolitan area, and that is a 5-county area in northern New Jersey, declined about the same pace as the nation, as did Fairfield and Puerto Rico. Another group of areas, including the Edison metro area, which is a 4-county area in North Jersey, as well as Bergen, Hudson, and Passaic County, also declined at rates that were close, slightly below, but close to the nation, as did Kingston and Glens Falls. Roughly on par with the region, Putnam County, that's Rockland, Putnam, and Westchester counties, and Elmira and Binghamton, but declining relatively, compared to the nation, less steep. Poughkeepsie, Long Island, and Syracuse, as well as a number of metropolitan areas across upstate New York. So again, what we're seeing is variation across the district, with upstate New York generally declining less than the nation, as with New York City and Long Island. But again, there are very few areas here that really saw job losses that were much steeper than the nation. Okay, so that concludes the discussion of the downturn. I'm now going to turn to my colleague Jason Bram, who will talk about the employment recovery to date in the region.
Thanks, Jim. Okay, so I'm going to start off talking a little bit about showing you some charts that are similar to what Jim showed in terms of industry percent change, but we're going to look at it in terms of the actual number of jobs gained or, for the most part, lost during the downturn and upturn. And I'm going to start off with New York State. So we're going to look at this is basically gives you a sense of how industries contributed to the overall change in employment. And just to illustrate, you see here during the downturn, education and health, which was the big growth sector throughout, added 76,000 jobs. At the other end of the spectrum, you have manufacturing, which shed 85,000 jobs. And it's important to note that this is fairly typical at the extremes of business cycles in the region, where education and health is the best performer, and manufacturing typically has the steepest declines. So what happened during the upturn? What drove the gains? You can see that to a large extent, the same sectors that grew through the downturn continued to add jobs in the upturn. Education and health, largely health. This is private education and health, I should emphasize. Leisure and hospitality as well. Finance and trade were also contributors, and the big upturn was in a very important sector in the region, which is professional and business services. So these sectors together, these service sectors, accounted for pretty much all the strength in employment. Offsetting some of these gains, you can see there were continued modest job losses in manufacturing and to some extent construction. Manufacturing is fairly typical. It's been in a long-term downtrend, so it's not that unusual for manufacturing employment to be growing nationally and still being a bit weak in this region. But what is the weakest sector? What's really been weighing on job growth? It's really government, which had held up pretty well during the downturn. You've seen some pretty steep losses, and most of that's in state and local government in New York State. Now, how about within New York State, obviously, is far from homogeneous. So we're going to basically repeat this chart first for Upstate New York. You see the same sort of pattern. Here, manufacturing is really the big loser during the downturn. And then during the upturn, you can see the same sectors generally as New York State were adding and jobs. One difference, of course, being financial activities didn't really do much in upstate New York. You had a slight bit of gain from trade, but most of the action is in, you can see those three sectors that we have in purple. On the downside, again, manufacturing really is the only, in the private sector, the only contributor on the negative side to any significant degree. And as is the case, once again, government, and most of that, again, is in state and local government. Now, what about New York City? Well, New York City, the downturn, the similar pattern during the downturn, except that here, of course, financial activities was the biggest negative contributor. And a lot of that, of course, was in the securities industry. So even though the downturn in financial activities wasn't quite as steep as in past recessions, it's still a key industry in the city and still accounted for the largest piece of the job loss. But you can see there were other sectors as well. Now, during the upturn, New York City had a few more growth sectors than upstate. So you have, again, leisure and hospitality, education and health, same thing as we've seen throughout. In addition to New York City, and professional business services is, again, a key contributor. In New York City, unlike upstate, though, you have gains also in retail trade, and in financial activities. You've had some rebound in the finance sector, and a lot of that's coming in the securities industry, which I'll talk about a little more in a few minutes. But the trade and leisure and hospitality reflects the fact that one of the areas that held up and has continued to grow during the upturn has been tourism, and that's driven a lot of the strength in trade and as well leisure and hospitality. Now, what about New Jersey? Why was and government, of course, in New York City also has been down quite a bit. So in New Jersey, you can see first from the downturn, you can see that the downturn in employment was a bit more broad-based than in New York. You had lots of industries basically losing a lot of jobs. And again, only education and health in New Jersey showed growth. So this explains why it was weaker in the downturn to some extent, but why has it been so sluggish in the upturn? So you can see that in New Jersey, like in New York City, you've had a number of sectors adding jobs. But the most important contributor in New Jersey, and unlike New York, it really almost all of the job gains have been driven by professional and business services. You've had education and health growing, but you can see it's a much more modest pace of growth. You can see leisure and hospitality, finance is up a little, and trade is up a little. But you're not seeing any big gains really outside professional and business services. On the downside, during the upturn, holding back some of the job gains, once again, same pattern we see in the rest of the region, manufacturing and construction, seeing job declines. But one of the major reasons why New Jersey has been the weak performer, at least during the upturn, has been in government, which again, it's the same pattern that we saw in New York, but the job losses in New Jersey are even steeper than in New York, and we'll get into that a little bit in just a few minutes in a little more detail. So now, how did the various parts of the region do during the upturn? We're going to look at basically group metros like Jim did for the downturn according to their relative performance to each other. And one thing that you'll notice is that in contrast with the downturn, most of the region has been lagging the U.S., has underperformed the U.S. in terms of the strength of the rebound. And you can see that U.S. as a whole has added, employment has rebounded 1.2%. That's before today's report, so you can add a couple of tenths onto that. And in the region, it's grown, but not quite as strongly, and let's see why. So we have these areas have been the weakest performers. The areas in brown have continued to see declines, although fairly modest declines. Puerto Rico, Albany, and Utica metro areas. In Puerto Rico and Albany, I should note that a lot of the weakness, especially in Albany, has been in the state and local government sector. Then we have these other kind of sluggish performers where employment still has edged down a little bit more. Binghamton, Kingston, and Poughkeepsie. These areas have been seen just only very slight job growth. Much of northern New Jersey, the northern suburbs, Putnam, we call Putnam. It's actually Westchester wouldn't fit on the label. So it's Putnam, Westchester, and Rockland counties. And so these areas have seen, sluggish job growth. And it's important to note, though, that even a lot of the areas that are like Albany and Utica and Poughkeepsie that are really lagging in the upturn, it's important to remind us that these areas really were much less affected than even the rest of the region during the down part of the cycle. And then in this teal or light green, you can see a few areas in upstate, Long Island, the Edison metro area in New Jersey. And really the only areas that have outperformed the nation, even on the upturn, have been Fairfield County, Connecticut, and New York City as well. So that's pretty much what's happened in the upturn thus far, which is still going. What about the outlook? So what I'm going to do now is focus on a couple sectors that are key, in a sense, to the regional economy insofar as looking ahead goes. The first one of these, obviously, is state and local government. This has been much of the source of weakness, not only in the region, but throughout the nation. And you can see that employment, we index this, by the way, to, so we'll have the region on here, to the beginning of the recession and the employment downturn, which is at the end of 2007. And you can see that that employment held up in state and local government pretty well throughout the downturn. This is across the 50 states, both in the U.S. and in the region. And what's happened is one of the things that enabled, and this is typical pretty much in a business cycle, as the revenue starts coming in weaker, in other words, the weakness in the private sector translates into weaker tax revenues. April rolls around, tax revenues aren't coming in as strong, and it takes a while for the government to start cutting back on things like teachers and other jobs. So in addition, you've had federal aid was supporting, to some extent, state and local governments during the recession, and that's no longer the case now. So you're seeing this sort of delayed reaction at the state and local government level. Now, how has New Jersey fared? This has been a big source of weakness in New Jersey, just in terms of the sheer job counts. New Jersey has seen big declines in government that were steeper and earlier, I would say, than in other parts. So in other words, the employment has declined substantially in 2010, seems to have leveled off a little bit more recently. And looking ahead, you can kind of look to state budgets to get a sense of what's going on. Now, there were steep cuts in New Jersey's budget last fiscal year. This fiscal year, the budget is pretty much unchanged from last fiscal year. That doesn't mean employment will be unchanged, but it suggests that the worst of the job cuts may be over in New Jersey. But that's something that, of course, we're looking at closely. Now, New York State has seen less steep job cuts, more in line with the other 50 states thus far. Of course, there's the risk of drag going forward. Now, it's interesting to note that in New Jersey, the magnitude of job cuts we've seen in state and local governments is the steepest we've seen in decades, and the only thing that even comes close is in the early 80s, but even those cuts were not as steep. In New York State, the magnitude of job cuts has been moderate so far, and we're still not up to anywhere near where the level of job cuts we saw in the early 90s when we also had a big fiscal problem. And never mind the 70s, that's a whole other story. But I think what this suggests is that going forward, New York State, with budget cuts looming for the upcoming fiscal year, this is something we're going to be watching to see what happens with total employment. Now, of course, the outlook for government employment, depends on the government's fiscal situation, which in turn depends on how tax revenues are coming in. So what is the big source of tax revenues in New York City and New York State? Wall Street. So we're going to take another look at Wall Street, the securities industry, which is a subcomponent of the finance sector. Now, this is a very important industry in New York State and especially New York City. It accounts for securities, for example, accounts for about 5% of employment in New York City, which is about 10 times the national average. And it accounts for roughly, at different parts of the business cycle, it varies, but 25 or so percent of total income earned is directly coming from Wall Street. And that doesn't include, people earning paychecks from companies that serve Wall Street in advertising and legal and other services. So the securities industry is obviously an important industry here. And if you look at the cycles, what this chart shows is basically Wall Street securities industry employment, which is scaled to the left scale. That's the blue line. And then the sort of gold or yellow line is employment in other sectors in New York City. And you can see that at each of these turning points, at each of these troughs in employment, securities industry begins adding jobs before other sectors. In the 70s, early 90s, and by a few months at least in the early 2000s. So the recovery typically starts on Wall Street. What's interesting in this last cycle is that, and here's a little inset, what I'm going to call Main Street, which is basically other industries, actually started adding jobs before Wall Street. So basically the upturn started 4 months earlier than Wall Street in these other sectors. And it reflects underlying strength in sectors outside Wall Street. Right? Something's driving growth in the broader economy. It suggests that basically the economic fundamentals outside Wall Street were improving as early as toward the end of 2009. Now, what's encouraging is that more recently, both Wall Street and other sectors have been adding jobs. And this bodes well, obviously not just for the cities and states' economy, but also for the fiscal situation. Although it helps, let's just say. Now, I'm going to turn to, so far we've talked pretty much, we've looked across the region geographically, we've looked at how the different industries have fared, but there's another dimension to the employment situation that we can look at, which is occupations. In other words, industry is, you have Wall Street, you have retailers, and then occupations are kind of what people do. You can have computer programmers, you can have managers, and so forth. And so we're going to take a look just briefly at what's been going on with the occupational demand, I guess. Now, the Conference Board has an interesting data set that we've started using on help-wanted advertising, online help-wanted advertising. And although we only have data going back a few years, so it hasn't been through a lot of business cycles. Obviously, online advertising isn't that old a field. We do have data, going back through the early part of the recession, and it does seem that this measure of advertising did turn down before employment turned down, and it started turning up before employment turned up. So it seems to be a reasonably good sort of indicator of labor demand. And if you look at the past year, we're just going to focus on basically the first quarter of this year versus the first quarter of 2011. What you see is that there's been an 18% increase in the number of job listings in the U.S. New York's done even a little bit better, up 20%. And in New Jersey, a more moderate but still a gain of about 8%. So the question is, we can also look at what occupations the gains are in. And basically what we did was there are a lot of different occupations, and but we tried to say, of the sheer increase in the number of job ads, what was driving most of it? In other words, where were the largest increase in numbers? So nationally, you can see computer, healthcare, transportation management, and retail. You see sort of similar things going on within the region. And one thing that jumps out is that these are, to a large extent, high-skilled occupations, sort of what we think of as knowledge-based occupations. And that's a lot of what's driving it. These tend to pay a little bit more than the average jobs. On the other hand, we do have, obviously, gains in retail and sales. In New Jersey, of course, transportation is a big sector. And you're seeing some gains in some of the lesser knowledge-based or skill-based occupations. But, to a large extent, you can see the sort of tech sector is driving a lot of the growth here. And so this is something that we're going to continue to monitor, to see where the job demand is coming from. And that pretty much wraps it up. So just to close up, to highlight, there's been really substantial regional variation in the downturn. The recovery of jobs to date, since last year, we have strength in most private services, at least some strength. Modest job losses in manufacturing and construction, not so in the nation, at least in manufacturing, but in the region. And of course, the big negative or the big drag is mounting job losses in state and local government. And then going forward, you can see that these industries have added jobs steadily: health and education, leisure and hospitality, professional business services, and financial activity. These are likely to continue to contribute to growth going forward, just because you have a lot of sort of momentum in these areas. And then pickup in these online job listings in the past year is encouraging, and it's been driven largely, but not entirely, by higher skilled occupations. And then finally, the downside risks from state and local government fiscal restraint. This is a downside risks simply on the level of employment, is something that we're monitoring. But I should note that when you're looking at, because I know there's concern, will these declines in state and local government impede the expansion? And I think it's important to note that state and local government jobs account for about a sixth of employment in the region, whereas the number of jobs in the private service sectors that are adding jobs account for about 50% of employment. So what's going on is you have a fairly small sector is continuing to lose jobs or has continued to lose jobs, but this should be more than offset by growth in these private service sector growth industries. And that pretty much sums up, whoops,